is Dr. Duru from Ahan Analytics with the market breadth. All right, for the week ending December 5th, 2025, for me, it was mostly about individual stock stories in the financial markets, and that's what I'm going to focus on with the charts that are coming up. The thing that I was really watching for is how would the market respond to a huge up week to end November. I mean, a massive recovery week. I just have the stats really quickly. S&P 500 was up 3.7 for the week. This week, for the previous week. For this week, it was only up 0.3%. NASDAQ was up 4.9% in the previous week, now up 0.9% this past week. And then IWM, the ETF of small caps, was up 5.6% to end of November. And then this week, it was up 0.8%. So I think these weekly performances were pretty healthy. Given the big moves to end November, buyers easily could have just taken profits and pulled down. But I think what's going on is people are now anticipating the Fed meeting that's coming up next week, December 10th. We'll get the monetary policy announcement, pretty much a lock for a rate cut. And now all people want to see or hear is the Fed continuing to be dovish and not talk all that hawkish talk that came from the last meeting where the market actually topped and is yet to recover back to that level. So next week's going to be very important to see what happens. And then, of course, we have the end of year rally, end of year positioning. And that's another thing to keep an eye on. The momentum is biased to the upside to end this year. And that was enabled by all that selling in November, created a lot of buying opportunities for everyone. Okay, let's jump into the few select individual charts whose stories caught my interest. It's the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. As you know, for months on end, I've been worrying about this downtrend as represented by the purple line. We are still in a downtrend for market breadth. So this means when the downtrend was at its steepest, it got to a point where the majority of stocks were breaking down, even as the indices were doing okay. And that all came to a head out here in November when market breadth fell to its lowest point since late April. It was a very significant point. I thought we might continue down to oversold. But then, of course, as you know, last week, buyers turned right around and things shot up, primarily because the hopes for an interest rate cut in December soared back into the high likelihood. Now, I have my eye on this downtrend, and let's take a look at what happened. Look at this. We were creeping higher for the middle of the week. And then at the highest point, we reached right up to that purple line and then faded. So now I have to worry all over again. I was hoping that we could confidently, we meaning the stock market, could confidently push right through this downtrend line, and it failed. But still, I'm looking at a end of the year rally. So let's see if next week, particularly going into and out of the Fed, the market can regain some market breadth. All right, let's take a look at the S&P 500. S&P 500, as I said, this week, I think did pretty good to hold on to last week's gains and then tack on a little bit more. As you can see here, we are almost at, we're almost at the all-time high. Ominously, at the intraday high, you can see here, there was a little fade from the all-time high, the all-time closing high. So that's something to watch. It's very subtle. I mean, you have to get a magnifying glass to see that, of course. But overall, the S&P 500 is maintaining its renewed bullish bias. Same thing with the NASDAQ. You can see here, it did not come nearly as close as the S&P 500 did to its all-time high, but the good news is it held on to its big gains from the previous week and is still in bullish position. And we have the same thing for IWM, the ETF of small caps, or iShares Russell 2000 ETF. You can see it actually made a new all-time high on Thursday. Yeah, this was very bullish. A new all-time high, all-time closing high. So I'll move that over there. And then a small pullback, not going to really worry about that, except to the extent that was a primary driver of market breadth failing to break through the downtrend. But still, IWM's looking great. It's now outperforming on a relative basis the other indices. So I love it. I love it. I love it because IWM has been my core position for the extended period of time in a comeback. All right, let's take a look at the individual charts. Like I said, there were some individual stories that were really important. Netflix has confirmed a breakdown. I already mentioned it's in bearish position because, and primarily I think was weighing down the stock is this bid for Warner, and that bid came out. I think it was almost $28 a share. Maybe it's a little over $27,000. Sorry, $27 a share. I think it's going to be all cash. And as you can see, investors are not happy about this. The speculation was a really heavy weight on the stock, and then today we dropped almost 3%. Interesting, wild trade action. In fact, let's just go ahead and take a look at the intraday, the 15-minute, just to see what happens. So you can see right here, as soon as the market opened, Netflix gapped down, and then buyers stepped right in. In fact, took Netflix to a gain. So these are the people who were probably thinking selling is exhausted, but sellers stepped right in, and they were relieved to get this uptick, and they took Netflix right back down. Now, Netflix didn't break back below the intraday low. So for now, if you're a trader, you can assume that this is a bottom until it isn't. I am still not trading this. I really wanted to stay short. I won't review all of those details, but I don't want to trade Netflix here. Let's see how the dust settles, whether this bottom holds or if it fails, and then Netflix continues to be an even bigger short. Now, talking about streamers on Spotify technology, ticker symbol SPOT, as I see this stock continue to break down, I am actually relieved that I paid attention to the technicals. For those of you who read the blog, you'll know that I got into Spotify somewhere around here, and I had planned to hold it for the long term. I did not like the way it broke down below its 200-day moving average. I was tolerant of the breakdown below the 50-day moving average, but I did not like the 200-day moving average breakdown. You can see how the bearishness developed. The 20-day moving average has stayed as tight resistance as the dashed line, stiff downtrending resistance. Here, Spotify failed right at that convergence of resistance and has not been the same ever since. Sellers have been taking Spotify down and down and down. I do not have a specific catalyst for why Spotify is suddenly out of favor, except to say that Spotify is a very expensive stock, so it can go down at any time people want to re-rate it for a more reasonable valuation. So let's see. So now Spotify might be getting interesting again. It's getting down to levels last seen at the beginning of May and the end of April. If it tests these April lows again, I think I might have to take a risk and try it one more time, but we'll see what happens as time unfolds. Microsoft was another individual story that was interesting. Rumors went around on Wednesday that the company had slashed sales expectations for AI. The stock came down 2.5%. You can see buyers are stepping into this as a buying opportunity. It's creeping higher. What I'm looking at overall is how well Microsoft held this 200-day moving average support. I added to my position on that, and this is what I want to stay intact. If Microsoft breaks below this low, just like with Spotify, I just can't hold on to a stock when it breaks an important trend line like this, long-term trend line, in an ominous way. So I would be forced to just get out and then wait for the dust to settle to see how to get back in or when to get back into Microsoft. So that's the deal with Microsoft. Meta had the reverse news. So you see Meta has been way down for a while. I've been talking about how bearish Meta was. First warning sign was way back here in June with this gap and crap to a new all-time high. But now the stock crept up as if in anticipation of the big news on Thursday that Bloomberg reported that Meta was considering budget cuts up to 30% for its metaverse group next year. I'm assuming that there's two things going on here. One is that who even knows what metaverse is anymore? It doesn't seem like it's going to go anywhere. And two, Meta has to be scrambling to figure out how to scrape up its pennies and nickels to fund all of its AI ambitions. So the investors are very happy with that. The stock gapped up and gained 3.4% for the day, but you can see here, let's zoom in, technicals are weighing, converging resistance at the 50-day moving average, the red line, and the 200-day moving average, the blue line, and Meta is right now stuck. If it breaks out above that, Meta becomes bullish again. If Meta closes below these candles, I'm going to consider this a continuation of Meta's bearish positioning, and I will trade accordingly. All right, let's move on. I talked about AI really briefly. I got to squeeze in AI into anything about the stock market. Credo Technology Group, ticker symbol CRDO, survived earnings. It gained 10.1%, but sellers took over from there. In fact, the sellers really took over from the intraday all-time high at 213 and have been fading the stock mostly ever since. And now you can see Credo has almost filled that gap. So I'm going to be on gap fill alert, watching to see what the stock does from here. If it rebounds, I want to buy. If it continues down, I'll assume that Credo has topped. And then I'll be looking out for more bearish action, like a break below this low, below the 50-day moving average, then this low, and then a test of the 200-day moving average. But one step at a time. Right now, I'm on gap fill watch for ticker symbol CRDO. All right, let's continue on with the technology and AI related stuff. This is database, actually. Snowflake, ticker symbol SNOW. Again, a very expensive stock, so it can go down for almost any reason, but this reason was earnings, went down 11.4%. You know, investors have high expectations. Snow didn't meet them. Now Snow is back into bearish position. That was confirmed by follow-through selling today, 2.6%. This is not a stock that I want to short because at any time the stock can just soar as well. This is a highly favored stock, even though it's still well off its all-time highs from the double top in 2021, 2022. It's just a very volatile stock, and I just don't want to be caught short when suddenly, for some random reason, buyers decide that they want to trade this thing higher. But anyway, Snow is back into bearish position, so it's a no buy for me. Let's go on to a related stock, MDB, ticker symbol MDB, MongoDB. It had the reverse of Snow. And I think this also could have, Mongo's good results earlier, 22.2% post earnings, may have also set up Snow for higher expectations. Now, MongoDB is still off of its all-time high, and you can see it's really kind of dead money if you extend all the way back to 2020. But I think it's slowly but surely getting its sea legs back, so to speak. And, you know, it's looking good. It's holding on to its post-earnings gains, and the sellers haven't been able to push the stock much further. I hesitate to buy it without a deeper dip, but you know, if it hadn't been for earnings, I would have bought this dip because it was into the 50-day moving average support. So this is, again, just a stock I'm going to keep an eye on. If a good entry comes up, I'll get in. If it doesn't, you know, oh well. For a stock like this, I really want a good risk reward entry. All right, another storage related stock, Pure Storage, ticker symbol PSTG. The same time that MongoDB had a good day, Pure Storage did not, plunged really 27.3%. The only good news here is that sellers have not been able to push the stock even lower, but I suspect a test of this 200-day moving average is imminent, the blue line. And on top of that, it's possible that sellers are going to want to refill this gap just from the last earnings. You can see Pure Storage had a great post-earnings gain of 32.3% back in August. So it's unfortunate that I guess people just can't tell what to make of this stock. If I zoom back here, Pure Storage is in an overall uptrend. It's just extremely choppy. So I am looking to buy this one if it can hold 200-day moving average support, and particularly if it can hold support on a fill of the August earnings gap higher. Now, the biggest disappointment of the week for me was Domo, ticker symbol DOMO. This is a data analytics platform, software platform. I've talked about this stock before. I've written about it before. I'm I've come back to using the platform. I've been impressed with the features that they've rolled out and the improvements that they've made. But apparently, sales are not really keeping up to what investors want to see. Sales growth, And now the stock has done a complete round trip. This is back, if you remember that video, it had soared 26.9% post earnings. I thought I had missed the stock. I went ahead and bought some dips. I traded. I got out of the stock when I thought it had gotten overextended up here. And then I started slowly reaccumulating shares. But I got nervous ahead of earnings. I sold a call option against part of my position. That's scant comfort for a 23.6% drop that's now reversed all of this gain, all of this breakout. And this is even more important because Domo is so far off of its all-time high. I don't think it'll ever get back here. From 2021, it was trading almost at 100. And if I don't go so far back, you can see that Domo is in danger of going back to becoming dead money. It looked like it was very constructive breaking out here, but it's now returned to this kind of consolidation range, and it could be stuck here for many, many, many months to come. So nothing for me to do here. I'm just holding this position. I'm just taking a risk. I like the product. I think they'll make this work. I think people come around. If not, the stock is very cheap. They could be acquired at some point. And that I'm not betting on an acquisition, but I'm hoping that prospects of an acquisition do put an eventual floor on this stock. All right, let's go to consumer, because this is another important thing, particularly as we're going into Christmas and beyond. This is an important sector to keep an eye on. So this is XRT. This is the State Street Spider S&P Retail ETF. You can see it held 200-day moving average support pretty well back in November. Now it's done this bullish breakout above the 50-day moving average, and buyers have not looked back. Look, even today, on a day when market breadth had a setback, XRT was up 1.2%. So people are willing to bet on the consumer, and XRT is looking good. I missed this breakout. I will put XRT in the buy the dips category, but it looks good, clear runway to retest its near 4-year high. Now, having said that, there are some retail stocks that are bad and some that are good. Etsy, I keep looking at it because it's had some really wild trading action that, whether you're a bull or bear on Etsy, provided great opportunities for entries, good risk reward entries. Right now, it's in bearish position below the 200-day moving average. And in fact, look at this. It failed right at that resistance. So the bearish conditions hold. If it breaks to a new low, then it becomes extremely bearish. I don't want to short this one. I've been looking for the next buying opportunity, but that buying opportunity eludes the situation for now. All right, here is one, Abercrombie and Fitch and Company. I wrote about this earlier in my blog. I was talking about how I really like the commercials I've seen during football season, but I just couldn't get into the stock because it was in bearish position. And at the time, you could see football season started in early September, and those commercials clearly didn't help the stock as it continued to sell off for the next month. And then it consolidated ahead of earnings. Look at this. It actually dropped 6.1% ahead of earnings, but that was a total faked out move. Post earnings, it soared 37.5%, well above the upper Bollinger Band, which is this black line that defines the majority of price volatility. Of course, this is not a move that I can chase and get into, so I've just been waiting for the stock to cool off. Look at how strong this buying power is. Let's scroll in here. Look at this, 4 straight days, well above the upper Bollinger Band. Price action is finally cooling off. So now I've got my eye on Abercrombie and Fitch, ticker symbol ANF, got my eye on it like a hawk for a buying opportunity. Hopefully it can test and hold this 200-day moving average support. Ominously now, though, where it failed, where the buying momentum slowed down is right here. Check that out. This was the previous high. So that's a little ominous, but I suspect after such a big and strong post-earnings move that eventually buyers will recollect themselves and break through that high. We also had on the low end, very strong moves. Dollar Tree breaking out to new highs. In fact, let's look back. It's not an all-time high. It's a new, let's just call it a new 18-month high. That's so impressive. Dollar Tree, ticker symbol DLTR, of course, is a discount retailer. It had a great post-earnings gain. I think it was one of these days. I don't know if this was a morning reporter or evening reporter, but regardless, this whole move has been very strong. high volume, trading volume down here. It's looking great. Big breakout. So this is a buy on the dips. Of course, for my taste, it's overextended in the short term, so it's not a stock that I'll chase. Same thing with Dollar General, ticker symbol DG. It's had an even stronger move, even more bullish breakout, but I'm going to buy this on the dip. It soared 14% post earnings. This is one where I've talked endlessly about Dollar Tree and Dollar General. This is one I should have just bought, both of them. I should have just bought and just stayed on top of it and not been so scared of what earnings could produce. And particularly for Dollar General, look at how nicely 200-day moving average support held around here. I'm sure it failed at 50-day moving average resistance. For short-term traders, this was a very juicy setup for a bearish short move. But overall, I like this whole setup, and it produced great momentum going into earnings. So that's a good one. So that's it for retailers. Lots more to tell there, but let's keep it moving. This is Booz Allen Hamilton Holding Corporation, ticker symbol BAH. It was on my radar because of this news. Let me zoom in here for you that the chief executive officer, the CEO, made a huge commitment buying $2 million worth of shares. But you can see that the market was not impressed. And after the stock, so I sold a put option around here. I can't remember the exact timing of it, but I sold a put option thinking the stock would just kind of hang around, as clearly the market wasn't all that excited, but I didn't expect it to come all the way down. So I was put those shares. And then on this first move up, I sold an $85 call option. And I am overall positive on the stock, but now I'm looking at potentially having this stock pulled, what's called called away from me because it's now in the money. So we'll see. It's got 2 more weeks to go. I'm not going to close out the call option and sit on the shares. I'd rather just wait and see what happens. And of course, a breakout above this 50-day moving average would finally confirm a potential turnaround for ticker symbol BAH. I love these insider buys when the CEO commits so much money. So regardless of what happens with my own particular trade, I'm likely to stay bullish on Booz Allen Hamilton unless some other bigger negative news comes along. All right, CCRN was my big disappointment as well for the week. Not as big as Domo because this one is kind of telegraphed. CCRN is cross-country healthcare. They do nurse staffing. Last year, late last year, caught a lot of news headlines. It soared 62% because of another healthcare company. I think it's called Anya, something like that, made a takeout offer. And you can see that was the end of it seemed like to be the end of the story, but then there were questions from the FTC as to whether it would be approved. And the stock was just never the same since. I was a big investor in CCRN way back here somewheres and then had to stop out and lock in my remaining profits. So when I saw this pullback, I thought, oh, this is the great opportunity for me to get back in the stock. So slowly but surely, I accumulated shares, just assuming that this merger would eventually be approved, but it did not. And the big warning sign, of course, is when this entire post-merger news gap was finally filled around post earnings. And that was the end of the end. And you can see the stock just accelerated its sell off into the news. Unfortunately, on Thursday, that the Anya, sorry, I can't remember the pronunciation, withdrew their offer, 20% loss. Now, I think that this is a total overreaction because now the market's acting as if this stock is worse off than it was right before this. And, maybe if you draw a trend line down, it kind of makes sense that it's now trading down into the $6 to $8 range, or eventually, it did. I think it traded close to $7. But now we're talking. I have to go to the weekly just to show you how far back down it's going. Now we're talking about levels last seen in the early days of the pandemic. I think this is so overdone. I still like this company, so I went ahead and added more shares on the day of the big disappointment. Now, if I were a short-term trader and I didn't have any positions, I probably would just go ahead and lock in the profits and wait for some more dust to settle to determine what to do next. So anyway, this is a very long-term play. This stock is clearly broken down. It's going to probably take at least a year, maybe 2 years for this story to heal. And I wish management luck in getting this business back in shape and then removing the distraction that merger acquisition news must have been. Okay, let's end this on another potential rebound play, which this is Ramaco Resources. You can read here all of my labels. The big news that happened for the stock earlier this year was commercial and technical feasibility of a rare earth deposit. I think it also caught some news in terms of rare earths and potentially getting government funding or a loan. But then the company on August 6th offered stock at 1850, and look at this, the stock actually held its ground. That was very bullish. I totally missed this opportunity. The stock went on to go into a parabolic run-up, and as long-term readers or viewers know, I never buy into parabolic run-ups because when they inevitably end, pullbacks can be very sharp and painful. And that's exactly, you don't know when it's going to end, but you do know it's going to end. And most likely that end is not going to look good. And here was the warning for anybody who was still holding the stock. This is the big warning here. This is called a bearish engulfing pattern because the stock gapped higher above the previous candle and closed below the previous candle at the end of a strong uptrend. That is very, very bearish. And you can see sellers just tore into this stock almost nonstop all the way into the end of November. And now buyers are finally gathering their wits together here. But, and this is a huge but, this 1850 has gone from impressive support to resistance. So until the stock can get above that 1850 level, it is still in bearish position. And you can see here, importantly, 1850 is converging with a downtrending 20-day moving average and this 200-day moving average. So this is some serious bearish resistance. All right. Thanks everybody for watching. Please please share and like this content so that the algorithm knows what's up. If you have any questions, you can put them down below in the feedback section. And you can ask any questions you have. Otherwise, please subscribe to the channel so that you can get more content like this, and it always helps to have more subscribers with the algorithm. Reminder that this is for your educational purposes. Please trade and invest with your own time horizons and risk tolerance in mind, and don't forget to do your homework. All right, take care. Thanks everybody for checking this out.